It's time to unify financial advice and mortgage broking. Hello again, I'm Martin North, the Principal of Digital Finance Analytics. The Royal Commission into Financial Services Misconduct has now uncovered evidence of poor industry practice from both the lending camp, including from mortgage brokers, and the financial advice camp. In both cases, their forensic analysis revealed cases of consumers being put into the wrong products, charged for services they never received, and on fee structures which were hardly transparent. In addition, some advisors and brokers were restricted by the product portfolios available via their organisations, and ties back to the big banks and other large players were often not adequately disclosed. But here's the thing. There are two distinct flavours of regulation in play, despite both being within ASIC's bailiwick. I believe it's time to move to a unified common set of regulatory standards to cover both credit and wealth domains. Lending and credit are based on ASIC's regulations for responsible lending, which requires both a lender and intermediary like a broker to ensure that the loan is not unsuitable. This includes looking at the purpose of the loan, making an assessment of the ability of the consumer to repay, and ensuring it is fit for purpose. What warrants as appropriate steps depends on the nature of the transaction and of the capabilities of the customers involved. So it's scalable. But that said, they are not obliged to act in the best interests of their client, and fee disclosure is at best rudimentary. Trailing commissions, for example, are not disclosed, and the precise meaning and definition of what is suitable is still subject to case law. But overall, this is weak protection, and as we've seen from the Commission, has failed to protect many borrowers. And there is nothing here about the best or most appropriate product, and it doesn't include any reference to whole-of-market analysis. Just at best, not unsuitable. On the financial advice side of the house, as is being explored by the Commission currently, under the FOFA rules, advisors must work in the best interests of their clients, disclose remuneration, and their relationships with product manufacturers, if appropriate. This is a whole different set of rules, again, regulated by ASIC. But note that this does not include finding the best product or providing whole-of-market advice. So the rules are slightly stronger, but still incomplete. Now consider this scenario. I'm a property investor who is seeking a mortgage as part of a strategy to build wealth. I will need a life insurance policy also. Who do I talk to? A mortgage broker can assist me with finding a mortgage, but cannot help with life insurance. But if I go and talk to a financial advisor, unless they're also a mortgage broker, they cannot assist with the mortgage. And if I find an advisor qualified in both regimes, which rules do they work under? And that's the point. The regulations, which, by the way, are an accident of history, in that the responsible lending laws evolved from earlier state legislation, get in the way of providing holistic, unified advice. A consumer has both credit and other wealth management requirements as part of a single issue. Indeed, there are trade-offs often, for example, between holding more or less investment properties versus investing in other market-related investment products. Indeed, it is feasible to wrap property investments into an overall wealth strategy. You probably should. So I suggest that now is the time to create a new unified set of rules to apply to all financial advisors, whether they're advising on credit or wealth products. They should be crafted around the best interests of their clients and should mean offering whole-of-market advice. That means creating an advice plan which spans both investments and lending. The plan should be based on a fee for service, and the advisor's remuneration should not be in any way linked to a commission or a revenue flow from a product sale. Indeed, we should break apart the advice element from the product sale and the application. I suggest that individual product applications could be completed by the advisor as part of a fee for service, but they should not receive any additional remuneration relating to a successful product sale. This would also have implications for ASIC, as it would reshape the advice landscape, but potentially could both simplify the regulatory regime and strengthen the protection for customers and help facilitate better customer outcomes. And down the track, advisors would require one set of qualifications and would become more recognised professionals. I believe the current chaotic regulatory environments, which were crafted to appease the finance industry, are inappropriate, and the time has come to create a single unified set of regulations. This would assist customers, but it will also help the industry on its journey towards professionalism. If you liked what you've seen here today, please like the post and add a comment or a question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. And I want to thank those who've already subscribed. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.